Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
After listening to today's news, you'll know first, the AI boom's grid tax sends US electricity prices surging 6.9%, fueling sticky inflation and complicating the Federal Reserve's rate cut narrative. So we'll discuss why this AI-driven energy demand creates persistent inflation and how it could force the Fed to keep interest rates higher for longer. Second, as China controls 87% of critical mineral refining, the US pressures allies to break the dependency, threatening a new wave of greenflation. We'll explore how this global push to de-risk from China could unleash greenflation and what it means for a potential capital expenditure supercycle. Third, India dismantles a jobs guarantee for 50 million rural households, sparking fears of a severe demand shock and a hidden fiscal time bomb. So we'll discuss why removing this automatic economic stabilizer could trigger a rural demand shock and what it means for investors in Indian markets. The AI boom is here, but it's coming with a hidden cost that's hitting your wallet directly. A surge in electricity demand from data centers is one of the key factors straining the US power grid and sending energy bills soaring for millions of American families. A while back, we warned that AI's biggest overlooked risk could be inflation driven by power and chips. And we're now seeing that cost show up on household bills. And this isn't just a temporary spike, it's the start of a structural shift. Researchers are calling it the AI grid tax, a hidden regressive tax on households. Continuing our last discussion on AI-driven energy demand, the latest detail is this. The International Energy Agency, or IEA, projects that global electricity used from data centers will more than double by 2030 in the US. Alone, the Department of Energy expects data centers to consume up to 12% of the nation's electricity by 2028. You know, we previously noted estimates suggesting AI data centers could even rival heavy manufacturing in power use. Today's numbers pin down just how fast the US share could rise. This is a massive accelerating demand that puts immense pressure on the existing grid. Official data shows electricity prices have jumped 6.9% from a year ago, far outpacing overall inflation, echoing investor warnings. We mentioned a while back that AI-driven inflation could upend the rate cut narrative. The real concern here is that this isn't just about your monthly budget. This kind of price increase is what economists call sticky inflation. It's not a one-time shock. It's a persistent upward pressure driven by structural changes in the economy, like this AI-driven energy demand. As we've discussed before, those cost pressures can arrive well before productivity gains, which complicates the Federal Reserve's job of getting inflation back down to its 2% target and could force them to keep interest rates higher for longer. For some, the reality is even worse. One family saw their monthly bill unexpectedly triple to $1,800, leaving them without power for 6 months. And they're not alone. Before the pandemic, a non-profit helping low-income residents saw utility debts between $400 and $900. Today, that number is often upwards of $6,000. We've said productivity benefits take time, but the bills don't wait. This is that lag in human terms. Now, get this, on the surface, the job market looks strong, but this surge in utility debt is what analysts call a canary in the coal mine for the health of the consumer. Utility debt is a lagging indicator. It only shows up on credit reports after a family is already in serious financial trouble. The fact that it's rising so sharply, even with low unemployment, signals extreme stress for lower income households and could be an early warning of a broader consumer credit downturn. However, if you zoom out, you'll see another layer to this problem. While demand from the tech industry is pushing prices up, policy shifts are adding fuel to the fire. One report from the climate advocacy group Climate Power cites the cancellation of clean energy projects that would have produced enough electricity to power the equivalent of 13 million homes. A few days ago, we also talked about a concrete example, Dominion Energy's fight over the Coastal Virginia offshore wind project after a sudden federal pause. That case showed how a single halt can ripple through Data Center Alley. Today's update widens the lens. This isn't just one project. It's a pattern of cancellations with system-wide consequences. What's critical for the investment landscape is that many of these projects were supported by incentives from the Inflation Reduction Act, or IRA, which offered tax credits to spur green energy development. The reversal of these incentives creates what investors call a policy risk premium, making them hesitant to fund new projects in the US. As we flagged earlier, that kind of uncertainty can choke the very build-out needed to meet AI's power appetite. The IEA has already slashed its forecast for US renewable energy growth by nearly 50% through 2030. This not only raises long-term energy costs, but also risks ceding leadership in green technology and supply chains to regions like Europe and China. The same report claims the move has contributed to a 13% jump in electricity bills since US President Donald Trump returned to the White House. The administration has pushed back, with Treasury Secretary Scott Bessent telling ABC News that local electricity prices are not something the federal government can control. This creates a perfect storm for consumers: rising demand from AI, a pivot away from clean energy investments, and climbing natural gas prices. And remember our earlier point from the Virginia case: when renewables stall, regions tend to lean harder on gas, which is usually more expensive and more volatile. And that last point, climbing natural gas prices isn't an accident. There's a major geopolitical story playing out. The US has been ramping up its exports of liquefied natural gas, or LNG, largely to support European allies. However, according to the Department of Energy, this strategy of maximizing LNG exports directly tightens the domestic supply, pushing up the price of natural gas here at home. So the thing is, this policy creates a direct conflict between foreign policy goals and the promise of lower energy costs for American families. That tension is exactly what we cautioned about when we looked at the trade-offs in pausing large-scale renewables. Without new clean power, gas does more of the heavy lifting and households feel it. Some states are trying to fight back, proposing rules that would force large data centers to supply their own power, but any relief will take time. So what's next? In the short term, we should expect continued pressure on household budgets from these elevated energy costs. The key things to watch are the monthly CPI reports for electricity prices to see if this sticky inflation persists, and any further updates on LNG export levels. We'll also keep an eye on any legal and regulatory moves around major renewable projects like the Virginia offshore wind case as bellwethers for how fast new supply can realistically come online. Experts warn that for now, residential energy prices are likely to stay elevated, leaving many families to echo the sentiment of one North Carolina resident who said, "I don't think things are getting better anytime soon." Speaking of rising costs and strained supply chains, in the tech world, that's not the only pressure point. The entire green energy transition, which could help with the power grid issues we just discussed, is facing its own geopolitical bottleneck. One country, China, currently refines up to 87% of the world's most critical minerals. We're talking about the materials essential for defense technology, semiconductors, and the entire green energy effort. The crucial point is that this dominance isn't just about mining the raw ore, it's China's near monopoly on the complex and often environmentally challenging asterisk processing times and times refining times stages. This is the part of the supply chain that turns useless rock into the high purity materials that modern technology depends on. Breaking this dependency isn't as simple as just digging new holes in the ground elsewhere. And now the US Treasury Secretary is saying he's frustrated with a lack of urgency from global allies to do anything about it. In response, the US has called a high-stakes meeting, bringing together the G7, the European Union, Australia, India, and South Korea. Together, this group represents a staggering 60% of global demand for these minerals. The stated goal: accelerate the move away from China's supply chain dominance. This push to build new non-Chinese supply chains, however, will almost certainly be more expensive. This is what some economists are calling greenflation. Actually, building these new supply chains in countries with higher labour costs and stricter environmental regulations means the price of these essential industrial inputs will go up. And we've already seen a preview of this. The price of yttrium, a key rare earth element, surged by nearly 1,500% over the past year, largely due to trade tensions. This kind of price pressure could complicate the global fight against inflation and force central banks to keep interest rates higher for longer. According to a senior US official, the message is blunt: urgency is the theme of the day. We really just need to move faster. This isn't a theoretical threat. China has already cut off supplies to Japan in the past and has recently threatened even stricter export controls. And these threats are becoming more sophisticated. China is now leveraging its dominance in that crucial times processing times stage. New rules require special export permits for a range of critical materials, and importantly, the technologies used to refine them This means China could create very targeted short-term production bottlenecks for specific Western industries, like electric vehicle manufacturing or defense contractors, long before alternative supply chains are ready. While G7 leaders agreed to an action plan months ago, a senior official says US Treasury Secretary Scott Bessent has grown frustrated with the slow pace of change, prompting this direct intervention. But this is more than just a meeting. The US is already putting its money where its mouth is, signing an agreement with Australia that includes an $8.5 billion project pipeline to counter China's market control. That $8.5 billion could be the starting gun for what's known as a capital expenditure supercycle. Think of it as a massive wave of investment into building mines, refineries, and processing plants across allied nations. This isn't a short-term fix. It's a multi-decade industrial project that could provide a powerful new source of economic growth, much like the boom in energy infrastructure investment did, because the average lead time to bring a new mine from discovery to production is over 15 years. Now, Washington is telling its allies that the United States is ready to move forward with or without them. An official stated the US is prepared to act with those who feel a similar level of urgency, and that others can join when they come to the realization of how serious this is. This isn't just about diversifying supply chains. It's a coordinated push by the world's largest economies to break a strategic economic stranglehold, signaling a fundamental realignment of global resource power. So, what should we be watching for next? The key is execution. The frustration from the US Treasury highlights the risk that this grand alliance could fail to deliver. The focal point will be whether these countries can actually coordinate on financing these massive new projects and, crucially, sign long-term purchase agreements to guarantee demand. Without that, individual companies are left vulnerable and the entire de-risking strategy could fall apart. For investors, this means the stocks of junior mining companies will likely be highly volatile. While the potential is huge, their success is tied to this very fickle geopolitical follow-through, creating a potential trap for anyone who misjudges the political will of this global coalition. While the world's largest economies are coordinating on massive long-term industrial projects, another major player, India, is making a monumental shift in its domestic policy that could have equally significant but more immediate economic consequences. It just dismantled the world's most far-reaching legal right to employment, a system that guaranteed work for 50 million rural households. This move represents a major divergence in global social policy. By comparison, Brazil's famous Bolsa Familia program uses conditional cash transfers to reduce inequality. India's shift away from a rights-based guarantee to a discretionary scheme is a huge pivot, a real-world test of a completely different development model, and it even stands in contrast to China's focus on common prosperity. The program, known as MGNREGA, was an economic lifeline. It generated 2 billion person days of work a year, stabilized incomes, and empowered millions of women. The impact on women is particularly striking. The data shows that under MGNREGA, female participation grew from about 40% in its early years to over 50% recently. This program became a critical engine for female economic empowerment. Recent surveys showed rural female labour force participation in India had surged from 24.6% to 41.5% in just 5 years. Scaling back MGNREGA now threatens to reverse these hard-won gains, potentially trapping more households in lower income brackets and hurting India's long-term growth potential. Even the World Bank, which initially criticised the plan, later called it a stellar success. Now, that legal right is gone. Prime Minister Narendra Modi's government has replaced it with a centrally managed welfare scheme. The new system removes the guarantee of work, meaning the government's failure to provide a job is no longer illegal. The immediate economic fallout is the primary concern. Removing this legal guarantee and wage floor could trigger what economists call a negative rural demand shock. Interestingly enough, even with the old system, real wage growth in rural India has been stagnant, averaging negative 0.4% over the past 5 years when adjusted for inflation. This means rural purchasing power was already being squeezed. Taking away the work guarantee could suppress wages even further, curbing consumption and creating a disinflationary wave that hits sectors reliant on rural spending, like consumer goods and agriculture. This move is being opposed by top economists, including Nobel laureate Joseph Stiglitz. The architect of the original plan, Jean Drèze, says the new system is like providing a work guarantee without any guarantee that the guarantee applies. Here's where the situation takes a more complex turn. The new plan centralises power in Delhi but shifts the financial risk to the states. This creates a hidden fiscal time bomb. The shift is expected to inflate what are known as state-level contingent liabilities, basically, hidden debts that could explode in the future. This is especially dangerous for poorer states. We are already seeing states like Rajasthan and Madhya Pradesh with fiscal deficits projected to be well above the central government's mandated limits. This new model threatens their creditworthiness and could force them to cut essential spending precisely when their citizens need it most, like during a downturn. If a crisis like a drought hits and demand for work spikes, states may be forced to ration access to jobs to avoid paying out, but the core conflict here is a sense of déjà vu. In 2020, the government pushed through controversial farm bills only to repeal them in 2021 after a year of massive protests. Critics are now warning that by removing a protection that millions rely on, the government is repeating a historic miscalculation. The previous system was an automatic crisis buffer, functioning as what economists call an automatic stabiliser for the economy. When a crisis like a drought hit, rural families naturally sought more work. The MGN-Rega system was legally required to automatically provide it, injecting cash into the local economy exactly when it was needed most. It was a self-correcting mechanism. Under the new discretionary plan, any failure to provide work during a weak monsoon or drought could cause rural distress to boil over. With grassroots protests already being organised, the stage is set for a major showdown. Under the old system, blame was diffused. Under the new plan, the finger will point squarely at Delhi, turning a potential climate shock into a political reckoning. So, what should we be watching for next? There are a few key focal points. First, keep an eye on India's monsoon forecast and performance. Any deviation from the expected above normal rainfall could be the first trigger for distress. Second, watch for updates to the Rural Distress Index and rural wage data to see the real-time impact on the ground. For investors, this creates uncertainty for sectors tied to rural demand, like fast-moving consumer goods and auto companies. A slowdown in rural consumption could put downward pressure on the Indian rupee and force the central bank to adjust its policy. This will be a critical test of fiscal stability and political risk.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.